Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in. Let's take a look, see what people are sharing. If you want to follow me, it's at Finance Finance. And if you want to join our community, you can sign up to finding-value.com. That's where I dive deeper into all of these topics and subjects, looking for potential investment opportunities, sharing those opportunities with everyone in the community, talking about fundamentals of companies, fundamentals of sectors, looking at things from a longer term perspective. I'm not looking at this stuff from a shorter term perspective. I'm not a day trader or doing swing trades in the short term. I'm looking for ridiculously outsized returns, which does come with volatility. And that's kind of what I'm focused on. And the ridiculous returns would be 10 to 100 times my money purchasing in some of these companies and holding for a longer time frame. 10, 15 years definitely is the longer end of it. So let's get in here. Steve Burns, trading is like surfing. You wait for the waves and ride the waves. You don't paddle out when there are no waves. You wait patiently for the waves. And that's basically all trading is. Trading is sitting there doing nothing for the majority of the time. You wait for the setup, then you hit the setup. And what I have found is trading just the technicals without understanding a larger, bigger picture view is a complete waste of time unless you have one heck of a strategy. Your probability of success increases as you add more information to your trading if you are going to trade. So you need to know where we're at with some of these cycles because it'll increase your probability of success. And then you want to look at the cycles of everything. Now, trading is you're kind of in and you're out. Longer term investing, you use many different things. For longer term investing, you want to use basically valuations and fundamentals of sectors and companies. And what I've found is when you tie it all together, is when you can really start to make a lot of money. Trading, what I've found, is kind of a waste of time. You're looking for setups, you're trying to extract 10, 20, 30, 40, 50, 60% on a single trade. But what happens is your probability of success is pretty low because trading is more or less trying to establish sentiment and playing sentiment and news and emotions. So your success is really low and you're going to get stopped out of the trades a lot. So you end up with not that much gain. If you take a longer term time frame where you stack the technicals, you stack the fundamentals, you stack um, of the sector, and then you stack the big money flow moves. That's where a lot of these really rich people of investors make a lot of money. And that is what interests me because trading is very stressful. You don't make a ton of money. And I see it as more of a waste of time. The investing portion, where you take a big position or bigger positions and you sit in them for, we'll call it a cycle. The cycles generally last, I'd say, about 10 years, and they produce really big gains depending on what you're looking at in some of these companies. So that's where I get really interested because it's not as stressful, even though you're going to have volatility and you're going to have to stomach some moves. And that's where the majority of people have made their money in the stock market. It's not so much trading. The success of traders is really, really low. And even the cream of the crop trader that everyone deems to be the best went bankrupt multiple times by taking leveraged trades and bankrupting himself. So if that's the best that the traders can do, I would say that trading is not it's not worth it in my opinion. Here's breaking. So China's industrial output grew 5.4% year over year in November versus market expectations of 5.2. Retail sales grew 3% year over year in November versus market expected 5.3%. And then fixed asset investments grew 3.3% year over year in January uh, to November versus expected 3.4%. So I'm talking about China just because China is going through a slowdown. They went through a large decline in the real estate market. Their demographic fell off a cliff and they're going through a deleveraging event. And right now, I think this is having an impact on a lot of different things in the market. It's probably having an impact on the dollar. It's having an impact on commodities. It's having an impact on everything. So China is something to watch. It's not like they're declining in terms of oil demand and stuff like that, but they're still recovering and they're going through a recovery phase that's going to take some time. Stephen Goldstein says, if you find yourself taking profits too early, letting losses run, undersizing risk, overthinking, overtrading, or dealing with fear, doubt, and FOMO, remember, these are behavioral issues, not technical issues. More market analysis or new trading strategies won't solve them. The change begins with you. So there are things where you can have a strategy, but FOMO, fear, overtrading, overthinking, undersizing risk, those are behavioral issues. And those are things that people have to solve if you want to take positions. Now, each person's different. It may require different investments for different people and maybe less volatility. And maybe the stock market isn't cut out for you too, is another question that you might have to ask yourself. Nick Schmidt says your trading style has to match your personality. I agree with that. Took me years to realize I hated chasing short-term moves and loved riding long-term trends. Stop trying to trade like someone else. Find your own rhythm. That's the only way to last. I agree. I love looking at the big picture view, taking big picture charts and getting big entry points that may take years to develop, but the ultimate return is massive. Just to give you an example, one of my more successful, at least what I think is one of my more successful investments was in Palladium. I noticed Palladium was cheap in 2005 and again in 2009. So that took a good 4 or 5 years of me buying at those two big locations. I didn't know that well about ratios at that time. It was kind of by dumb luck and things being cheap and me just watching things. So I bought it at those two areas. I bought it a bunch in '05 and 2009 after the crash of '08, and I held on to it. I just held it, and I held until the ratios got expensive, and it got expensive in 2020 April against platinum. In that move, I made many folds increases. Like I think it was like a 16, 17x or whatever in paper dollar terms. I swapped it into something else, which is platinum, in April of 2020, and I've been riding the platinum train. Now, some people will say platinum against other metals, it just hasn't broken its downtrend yet. It hasn't broken this. It's like, well, we're running deficits. It is right on the cost curve. And whenever you buy something underneath the cost curve, you make money. So it's not about having investing is not about having only technicals. Technicals is a tool. It's a way of validating that the herd agrees or disagrees with you, yes. But you can also use fundamentals with some of these things to gain an advantage over everyone else. And that's why I consider myself a hybrid investor. I use fundamentals, I use technicals, I use whatever I know that I can use to my advantage and use it. So I like playing the long term trends. And some people will say, well, you can't get rich quick off that. It's like, well, you can, um, but it's also the least risk with the most potential. And you don't. People think that because they want to get rich quick that they have to take a certain approach. They don't control getting rich quick. That is more of luck. And what I'm doing is I'm taking a group of bets from a statistical standpoint. Some of them could work very quickly, some of them may take some time. And then you just let them go. And you don't know which one will be first, you don't know which one will be second or third. The people who do all the trading, they like to come off like they know when things are going to move, but they don't. They don't know. They may have an appearance of knowing, but they don't actually know. And yes, there are cycles that you can use to help yourself, but all I'm going to say is this. What if every bet that I took had gigantic asymmetry, like massive upside potential with very little downside risk? I don't have to win on everything. I just have to win on some of it, and I win on everything of the portfolio then. And that's really what investing's all about. That's what I've learned from Warren Buffett. That's what I've learned from some of the richest people in the world is that only 4% of their investments really made a huge difference in their account. And the asymmetry is what carried them and their long holding periods. Goldman Oil here, spare capacity likely weighing on deferred time spreads. What does that mean? So basically, what they're describing in this article is that we've got an unusual state of affairs. It's right in the middle there. So what does that mean? It says the oil market spare capacity is in the highest quartile of its history, at least what they think, while inventories remain near the lowest quartile. This setup is relatively infrequent, as investors and spare capacity tend to be positively correlated outside of price wars, but is historically associated with a more convex futures curve. And they talk about the low inventories impacting near term and the spare capacity impacting the deferred longer term time spreads. And that's what this article is kind of going over and how we're in this really weird situation. But I would also say there's a lot of weird things going on that we haven't seen in a long time. It's not just in oil. We're seeing the yield curve uninvert with interest rates going up. That's kind of weird. You don't see that very often. It's called a bear steepener, and it doesn't occur very often, but yet we are seeing it occur all the time. We're seeing what I think is probably a slowdown in the market, um, and I think they're fudging all the numbers. I think we do. We're probably in a recession with a bunch of fudged numbers. So we've got that going on. We've got a whole bunch of bond issuance on the short end of the curve, which is different than other areas. We've broken the 40-year downtrend of interest rates and we're starting to head higher. That hasn't occurred since the 1970s, basically. 1980 is when it ended. So we were going up in the 1970s. So this has been a long time. And there's a lot of things that we haven't seen here in the short term. Christine Guerrero says the US shale bros are like, we maximize efficiency by drilling cubes. Canadian heavy oil bros are like, hold my beer, I'm drilling a stingray. Look at this. This is awesome here. This really cool looking web of a drill location. And this is Nipisi, Nipisi, I don't know how you pronounce that, subplay of Clearwater play in Alberta. It's a headwaters exploration play. And we've seen these multilaterals in Canada a bunch. Kind of cool. says multilaterals have taken off in Alberta Clearwater play, with 8 laterals per producer becoming increasingly common. These wells are recovering on average 7.5 times more volume for only 1.5 times the cost. Completions can be costless because you can run this all through one area and then you stingray it out. Pretty awesome. I got to admit it for that. Coming here, it says, I don't think it realize how vulnerable they are relative to their lifestyle. I know a Google senior director who got laid off a year ago. Find any gig that is remotely close to compensation and responsibility. Worse, they cannot really do any IC work anymore or be humble. And ironically, director is literally the most fat at places like Google and Meta, especially since most of those people got overhired during ZERP. In tech, this is a very real human story that's happening. And I am seeing a lot of layoffs in the tech area, programmers, software, and looks like here some of these guys that are directors at these places, and they are struggling to find work. They're struggling to find anything that's comparable. So I feel for you guys. I what what drove me to save so much money when I was young was my uncertainty about my future. So I saved and I saved and I saved, and I didn't save everything, but I saved huge amounts of my income. So I could later on be free from the worries of getting laid off, from the worries of having problems financially. I also knew that I wanted to have kids even when I was in my 20s, and everything I did gave me the option financially, that at least my future self, the option financially to be well off. So I planned this ever since I graduated college. Another thing that pushed me to do that is I didn't really like, I didn't love my jobs. I didn't hate them, but I didn't really like them. So a lot of my jobs, the 9 to 5 jobs I had, I didn't love them, but I didn't hate them either. I was just kind of in the middle. So a lot of this just drove me to save money to kind of get away from it as fast as I could. That's really what it comes down to. This is a couple of different technical charts. Don't sell when the momentum, you can see the opening and closing prices are converging together. And then you can see this one's gapping bigger. And that's when you've got multiple candlesticks. If you get one large down candlestick that comes out of nowhere, that doesn't mean that it's a weird movement. It's when these things move up and down together and they start to accelerate in momentum. Ross Harbor says, years ago, I thought a 20% gain was a home run. This is dealing with trading. Then I let a true leader run for 300%, and it rewired my brain. The big wins teach you this: protect the downside, but never cut your upside short. Let the great ones work for you. And he still thinks that a 300% gain is huge. When you listen to the guys that made a ton of money, like a ton of money, like billions of dollars, what they did is they took a 5 or 6% position size in a company that was young and rode it for like 20 or 30 years of just ridiculous compounding. And they did it with only a company or two. They didn't do it with an entire portfolio. And their returns are 3,000 or 30,000% returns. So they made their money by finding a company that was very early in its growth phase, got somewhat lucky, but it's not really luck, because if you spread out amongst, if you're taking 5% position sizes, you can choose 20 companies. If you hit one gigantic home run and you can hold onto it and catch the entire asymmetry, that's how they made all their money. it's big, and remember, we're only looking at people who caught winners, these guys who have big winners. So it's people who bought Walmart when it was nothing and then held on to it, like the Waltons who created the company. There was somebody who bought Tencent when it was in the single digit millions and rode it all the way to multi billions with a 5% or 6% position, making them a billionaire. Those are the ones that I don't hear too much about. This is all, in my opinion, garbage. Even a 300% position isn't enough for me to take the position. I want to see something that is big over a 10-year period. I want 3,000% or maybe even 1,000 bagger, but I want 30 times, 50 times, 100 times my money at least for potential upside. Otherwise, 300%, I might as well just go buy physical metals or something because I think it'll beat that. Michael Girdley says, I've experienced because of business. It says he was awake all night due to anger, panic attacks, feeling like a loser, crying in the shower alone. All right, buddy, what's going on here? Dealing with no-win situations, awake all night due to stress, losing friends, breaking down in tears in front of family, being stolen from by trusted colleagues, losing close relationships and never speaking again, been embarrassed for letting people down. This is why experienced entrepreneurs won't tell you it's all wine and roses. I'm going to tell you this, guys. So when I was at work, there was a guy who acted like this. Total, just everything impacted him. He was crying one day about the stress that he was going under as a manager. So he basically gave up. He went back to being an engineer, and I took over all of his area and a whole bunch of different areas. And I didn't feel anything. I was not awake at night. I didn't have panic attacks. I didn't feel like a loser. I never cry in the shower alone. And I don't, dealing with no win situations, I dealt with a whole bunch of no win situations. A whole bunch. And you know how I dealt with them? I didn't really, I don't care about it as much. Like, you just have to go through it. And if it doesn't happen, it doesn't happen. I've been put in situations where, let's say, a normal lead time to build something, the entire group is 3 or 4 weeks, but they want it in a week. Do I worry about it? No. Why? Because there's nothing I can do in the situation that worrying is going to help me. So what I do is we try our best. If we hit it, great. If we didn't hit it, that's what's meant to be. I can't change being put in situations like that I have no control over. So I only control what I can control. And then what's out of my control, I can't do anything about it. So when this is all, I think, more of a personality trait than it deals with being an entrepreneur. So I don't think these two things are interconnected, in my opinion. People feel things completely different. Giovanni says tankers carrying Russian oil through European waters will be asked to prove they have adequate accident insurance or face potential sanctions, according to officials briefed on a new scheme designed to tighten up restrictions on Moscow's dark fleet of aging vessels. And some people were wondering why the tankers have pulled back. This is one of the reasons, is these dark fleet and the loosening of sanctions. I'm going to skip Howard Marks. This is a big one, so we'll skip through that. China real-time oil demand 16.6 million barrels a day in the latest reading. And here it is projected out forward in 25, 26. So if we're here in late of 2024, they've got an increase in demand coming in 2025 here, and then another increase later 2025. So to me, given where we're at, we have a one hump, two hump, third hump. And then we're going to have a breakout here out in the future of increased Chinese oil demand. But just recently, we have edged down to 16.6 million barrels right here. And in the future, we're going up over 17 very soon. At least that's a projection. Charlie Belillo says the market cap of new crypto meme coin called Fcoin is fast approaching $1 billion. Meanwhile, the Fed is going to cut interest rates again on Wednesday to further ease financial conditions. Yeah, this is really weird. It's like we've got a recession, but we've got all this money in the system just going all over the place in all these speculative areas, like Fcoin. So this guy says, to put things into perspective, the world currently consumes approximately 100 million barrels of crude oil per day. In comparison, the daily trading volume of petroleum futures, options, and over-the-counter derivatives now exceeds 5 billion barrels per day. 5 billion barrels per day. And this is that whole derivative contract crap. Is it having an impact on the physical pricing? I don't know. But I can tell you this, it seems a little weird. It seems a little weird. Here's Goldman's scenarios for gold prices over the next year. So exhibit, if the Fed cut rates by an additional 25 basis points only, the gold price would rise to 2,890 per troy ounce only by end of 2025, in their opinion. So rate cuts lead to higher gold prices, just like what I always thought. Another one from In Gold We Trust, the Crackup Boom, a term coined by Ludwig von Mises, says a breakdown occurs, the Crackup Boom appears. Everybody is anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. This is how a currency dies. So watch for a potential crack-up boom and a potential destruction of the currency. They just start exchanging money for anything whenever they get it. I kind of do that already, if you want to know. Morgan Stanley sees the risk of a power shortfall for U.S. data centers. Look at this potential shortfall. Are you kidding me? That's gigantic. And that's between 25 and 28. That's what is right on top of us. The potential shortfall is this big red boy here. This is the available U.S. grid capacity. And this is the power needed between 25 and 28. That's a gigantic shortfall. We are screwed. Like, what is going on here? So here, oh, and that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. I'll be releasing a midweek update generally at the end of the day, Tuesday. So look for it today. And yeah, I'll tell you what I like and what I think looks good in the markets and what I'm personally doing. But that's all I've got for today. If you want to join, use the word discount in the coupon code for a discount. And that's all I've got. So we'll catch you next time. This is Finding Value.